it allows you to to grow the money tax-free, take it out tax-free. But there's also a death benefit component. The approach calls for taking advantage of really every nook and cranny in the IRS tax code. We believe that there's 6 or so different streams of tax-free income that people should be aware of. And every single one of those streams of tax-free income is unique in some way and can accomplish something that the other streams of tax-free income can't do. For example, I love to talk about the Roth IRA. Maybe not all of your doctors will qualify, but they could maybe do a backdoor Roth. But really, a Roth IRA gives you instant liquidity on whatever you've contributed. So if I put in, say, $8,000 this year, I turned 50 a year ago, so I can now do that. So you put $8,000 in, and you want to take that money out a week later, you can totally do it. So it's got liquidity that a lot of these other retirement, tax-free retirement tools don't have. I love Roth 401ks because you get a company match, get an instant return on your investment. None of the other streams of tax-free income can do that. I love Roth conversions because Roth conversions allow you to convert an unlimited amount from your IRA or 401k to tax-free. I often joke that, Mitt Romney is purported to have over $100 million of money in his IRA, which it's a long story as to how it got that big. But he got $100 million in his IRA. And if he wanted to tomorrow, and he probably should, he could convert that entire IRA to a Roth IRA all in 1 year. He'd have to pay the tax, but I think he's good for it. The point is, you can convert unlimited amounts of money. There's no income limitations. You can just convert it all. So that's going to be a real workhorse in your tax-free retirement strategy. I believe that you should be leaving a little bit of money in your tax-deferred accounts. Why? Because you'll have a standard deduction in retirement. Okay, if you're married and retired today, younger than 65, you're going to have $30,000 of standard deduction. So I believe that you should have a balance that's low enough in your IRA at retirement that your required minimum distributions are equal to or less than your standard deduction. For most married couples, that's going to be about $350,000, but you also want it to be low enough that it doesn't cause Social Security taxation. So that's what I call the holy grail of financial planning, because if you have an IRA that's tax-free, think about it. You got a deduction on the front end, you grew it tax deferred, and then you took it out tax-free by offsetting that RMD with your standard deduction. And then we have something called, I've written several books about this, the Life Insurance Retirement Plan. Which basically what you're doing is it's a life insurance policy where you're getting as little death benefit as the IRS requires of you. You're stuffing as much money into it as the IRS allows in an attempt to mimic a lot of the tax-free benefits of the Roth IRA without the limitations of the Roth IRA. So there's no contribution limits, no income limitations. And this is something that does some really interesting things. It allows you to to grow the money tax-free, take it out tax-free. But there's also a death benefit component that you can receive in advance of your death for the purpose of paying for long-term care. This is a huge deal. If you're 55 or 60 and you're married, what do you and your spouse have 4 of? You have 4 parents. What's the likelihood that one of those parents is going through a long-term care event even as we speak? It's pretty darn high. And so most people are, as they approach retirement, they're thinking, I know I'm going to need long-term care somewhere down the road, but how do I get long-term care without the heartburn that goes along with traditional long-term care insurance? And this whole idea where you can advance your death benefit prior to your death and spend it on long-term care. And if you die peacefully in your sleep, never having needed long-term care, someone's still getting a death benefit, probably your kids, your grandkids. That's a very, very compelling way to address the long-term care need for a lot of people. So that LIRP, that cash value life insurance, can do something that none of these other streams of income can do. It's very unique. And then, of course, if you can keep your provisional income low enough, your provisional income is the income that the IRS tracks to determine if they're going to tax your Social Security. If you can keep your provisional income as a married couple below $32,000, then your Social Security all of a sudden becomes tax-free as well. And tax-free Social Security is great because it shields you from tax rate risk, long-term care risk, cost of inflation risk, longevity risk. So really, when you incorporate all of these different streams of tax-free income, all of the puzzle pieces fit together in just the right way, you can be at or near the 0% tax bracket in retirement. And we make a big deal about this because if you're in the 0% tax bracket in retirement and tax rates double, 2 times 0 is still 0.